Hello everyone, welcome back to our channel. Today, we're diving into ASC 842 and how to calculate an amortization schedule for leases. If you're ready to simplify your lease accounting, stay tuned. ASC 842 requires lessees to recognize assets and liabilities for leases longer than 12 months. We'll break down the process into easy-to-follow steps so you can handle lease accounting with confidence. Let's get started. Step 1. Identify lease payments. Determine all lease payments over the lease term. This includes fixed payments, variable payments based on an index or rate, and any payments for purchase options that are reasonably certain to be exercised. Step 2. Determine the discount rate. You need to discount future lease payments using either the rate implicit in the lease or, if not available, the lessee's incremental borrowing rate. Step 3. Calculate the lease liability. This is the present value of future lease payments, discounted using the rate from Step 2. Step 4. Recognize the right-of-use asset. The right-of-use asset is initially measured as of the initial lease liability, any lease payments made at or before the commencement date, less any lease incentives received, plus any initial direct costs incurred by the lessee. Step 5. Amortization schedule for lease liability. Prepare an amortization schedule to track the lease liability over time, which includes the interest expense on the lease liability and the reduction of the lease liability. Step 6. Amortization schedule for right-of-use asset. The right-of-use asset is typically amortized on a straight-line basis over the lease term. Let's consider a simplified example. In this example, the lease term is 3 years. The annual lease payments is $10,000, and the discount rate is 5%. The first step is to calculate lease liability. The present value of lease payments, using the formula, the present value of the lease payments is approximately $27,232.56. So the initial lease liability is $27,232.56. In the second step, we recognize right-of-use asset. Assuming no initial direct costs or prepayments, the right-of-use asset is also $27,232.56. Here is what the amortization schedule looks like. The interest expense amount is calculated by liability at the beginning of the period multiplied by the discount rate. The principal payment amount is calculated by taking lease payment minus interest expense. The lease liability amount is calculated by taking previous lease liability minus principal payment. Here is what the right-of-use asset amortization schedule looks like. The amortization expense is calculated by taking the initial right-of-use asset and dividing it by the lease term. The accumulated amortization is the cumulative amortization expense. To summarize, the lease liability decreases over time as lease payments are made, with a portion allocated to interest expense and a portion to principal reduction. The right-of-use asset is amortized on a straight-line basis over the lease term. This process ensures that the lease expense recognized in each period reflects both the interest on the lease liability and the amortization of the right-of-use asset. Thank you for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more accounting tips and tutorials.